Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to scroll through social media, Twitter, see what people are talking about. I'm going to sprinkle in my financial opinions as we go. It's going to be commodity, stock market, financial topics, I should say, and wealth building topics. So let's dive in. Let's see what people are talking about. If you want to follow me, it's at Finding_Finance. And if you want to join our community, become a better investor, check out finding-value.com. That is where I share a lot of my experiences and stuff that I'm looking at for potential entry points into individual companies and why I am doing it so you can learn as we go. All right, so we've got Logan here, and I'll be honest, guys, I'm in more agreement with Logan than the majority of other real estate guys. People call him a big bull in real estate. Um, I'm a bull in real estate because there's no evidence. There's a lack of strong supporting evidence to be a long-term bear. Yes, we can have prices fluctuate in the short term. I just don't see the supply. So he's talking about existing home sales here. He says the bar is historically low here with existing homes. So it won't take much to bounce from these levels. As we did last year, however, it does need the 10-year yield to go lower and stay lower with duration. And I completely agree with him. So we're looking at existing home sales. We had sales go up, they peaked, and then they came back down. This here was an oversupply phase in real estate that really hit in 05. And that's when everything came back down. I do not think that this here is an oversupply phase because we don't have existing home inventory. So much like he says, the bar is historically low here with existing homes. It won't take much to bounce from these levels because of the historically low inventory. We've got the demand out there. We don't have the affordability. So he makes the comment about the 10-year yield to go lower and stay lower with duration for sales to increase. I completely agree. The affordability is slowing everything down, but it's not, I mean, obviously it's not going to stop the housing market, but things are slowing down dramatically because of the affordability. If yields were to come down a good chunk and stay lower, I think the existing home sales would go up. And I'm in the exact agreement as Logan on his opinion there. If we get those sales to increase due to lower interest rates and better affordability in the market, that's where your inflation is going to kick back up, at least from the credit side, from the bank lending side. So it'll come. Tavi says, what an interesting chart. This is the largest number of workers on strike in the history of the data. I didn't even realize it was this many workers, and we'll take a look here. Corporate profit margins remain comfortably above their typical averages, leaving room to absorb elevated labor costs as profits dwindle. So this is the number of people. I got to move this over real quick here. There we go. The number of people employed but absent from work due to labor dispute. And look how many there are here. I mean, this thing's like off the page here. But there's a lot that are absent from work due to labor dispute. Joseph Brown says, the consumer is in trouble. Personal interest payments just crossed 500 billion. This level has never been seen in 60 plus years. Now, here's something that's kind of interesting. If you draw a line through here and you draw a line through here, that looks like an accumulation cylinder where you get 1, 2, 3, 4, 5, 6, 7, and then it explodes higher with personal interest payments. That also looks very similar to the Home Builders Index, which also looks very similar to the regional banking ETF and the price of that ETF. It's almost as if we're going to get a large lending deal going on at some point. And I know this is interest payments because the interest rates have gone up so much, but it's interesting to see how ingrained the herd moves into all of these charts because all these patterns are all roughly the same. And I have a feeling that commodities are they're putting in patterns like this, and they're all like located down here. And I have a feeling they're gonna go up dramatically at some point. So I just want to point out the pattern that I continually see. This is uranium. So uranium chart dating back to the turn of the century at $74 a pound currently. What is this chart telling you? What I would look at, and I've seen some people talk about, is uranium, is now the time to sell in uranium and swap over to like precious metals or whatever. And I'm looking at this chart like, are you guys crazy? This thing's like at the spot that's ready to go vertical. I mean, so you go into a decline, you go into a basing phase. Your basing phase is basically this portion down here. That's a big base. We popped out of the base and we're starting to rip to the upside. I mean, you'd be selling like right before the big move. Like, I don't know why you would even think of that. Uranium, I mean, you might as well just start changing these numbers here over the next year or two. And I don't know where it will ultimately end up, but I'm in the camp that we're going to go much higher. I'm in the camp that I don't think there's a possibility that we stop at 100. Like that's way too low. But again, I don't know how high it's going to go either. It depends on just how, I don't know, FOMO or scared, depending on how you look at it. Some people will be greedy and they're missing out on it from the fear of missing out, and other people's will be fearful that they can't get the product or the physical uranium. So this is going to get crazy, I think, and we're right at that point where it's like basically getting crazy. I think the last kind of resistance line, we got one here, basically right where we're at, and we have another one up here. So we've got a couple more resistance lines, and that's about it. That's it. When it comes to Fed-induced recessions, employment in residential building construction typically starts declining well before the recession takes hold. That is completely true. Currently, we are essentially at cycle highs, which doesn't match. See how we're going back up here, guys? That doesn't match a recession. Generally, you get a turnover in your residential building construction, and a lot of these slowdowns, like the recessions, it's generally driven by the real estate market. In 1990, we had a big bubble in real estate. And you can see that it turned before that bubble basically materialized. Our inventory started stacking up in 1990. We also had a lot of inventory stacking up in 2006, 2007. This is another one that rolled over. We saw a rollover in 2000 as well, as there was a slowdown in building. Do we have a slowdown coming up where we haven't rolled over? And that is where I disagree with the majority of people that say like a recession is going to be here immediately. I just don't know. Here, you guys can't see that. That's the end of this right here. It's still at a high level and it hasn't rolled over yet. And I know a lot of people are talking about recession and we're going to get this big rollover and it's going to be worse than 2008. But we're sitting here with no inventory of real estate, and your residential building construction continues to go up. And I think if interest rates go back down, they're going to keep going up. So I can't be in that camp, guys. I can't be in the recession camp. I mean, I'm not saying one cannot happen. I just don't see the data supporting it like I do in history, much like residential building construction. So I'm at a loss for words because a lot of people, they look at all this different data, and to me, the bigger portion of where a recession comes from is you gotta basically get unemployment going, and it generally comes from this area, and we don't see that slowdown yet. I'm not saying that we can't get it, I just don't see it yet. Rolling down, we got Triangle Investor. This graph should keep every uranium investor warm at night. And this is the uranium investment thesis: rapid realignment of scarce supplies And this is covered demand and uncovered demand. What does that mean? This is demand that's covered by, I think, a contract, while the uncovered demand, they need to get contracts for that uncovered demand. Now look at how fast this ramps up from where we are today in 2023. It's a pretty big ramp, which means we need to, well, not we, but people need to contract a bunch of demand. And you know what? That supply may not be there. Like, it could get pretty tight. And that's really where the whole thesis is, uncovering that supply demand imbalance. That's in millions of pounds, guys. If you look at the green over here in 2030, over 100 million pounds, and just keeps going up and up and up and up. This is Tim Hack. Again, I don't really care who posts this stuff. What I look for is the pattern, the logic, the knowledge behind the post. I don't really care who posts what, even if it's a person who's brand new. I don't know if Tim's brand new. Let me see what they've got here. He is 2,000 something subscribers. Either way, I hate when that does that. Resets it up there. So when looking at this, I think this is a beautiful looking chart. We've come on up, and this is basically a cup and handle ready to break out here at any second. Just because I say it's ready to break out, that doesn't mean that if we have a down day or a down week, that this pattern is, it's still valid. This may take a little bit of time for it to break out. It might take a couple of months. Don't get too short-term focused here. I'm going to remain bullish on silver. I've been accumulating silver ever since about 2018. I really started piling into silver. 2018, 2019 in this bottom here. I didn't get any at the bottom of 2020. Well, no, I did. I got some at the bottom of 2020. And then they jacked the premiums after I bought it. So I didn't get as much as I would like because the premiums really went up. I got one order in there that was a really good price. And then I got a bunch of platinum at the bottom, which filled, and I got deliveries of that at very, very, very good prices. But this thing is locked and loaded and ready to rip. Now, here's another comment I want to make is I'm in the physical silver camp. Okay, I own a bunch of the physical stuff, platinum, silver, whatever it is. And I'll express my bullishness on silver and platinum through the physical metals. What I get asked a lot is, well, what's a really good company that I can buy? And they want like a junior exploration company. All I'm going to say is that is not the same trade. Like, that's not even close. I'm looking at it from the physical side where I don't have any counterparty risk. And if governments tax the living crap out of this stuff from the miners because they're going to get desperate, then I'm going to make a bunch of money, and that's a moat around it, around the physical. The physical is going to continue to go up based off of whatever these governments try to do. So I look at this and I look at the moat around the physical, and I'm like, man, the physical is a really good play given the risk reward of the physical metal. And how the cost right now is below the higher cost producers of these silver specific companies. And then someone wants to basically take my bullishness and ask, how can I increase the most amount of risk on this trade? And I sit there and I think, like, why would you want to put on that much risk if the low risk option has a bunch of upside where you just, guys, this is like picking up $100 bills that are just laying on the ground here. You want to sometimes you want to express your trade in the least risk way possible. And everyone looks at the trade, or they look at the potential setup, and they say, how can I pile on the most amount of risk? Well, what if I said that silver's got a 10 or 20x upside from where it is today? What if it can go up up to $200 or $300 or $400 on its gigantic cup and handle pattern that's been developing? And you've got maybe a year or two or three that you might have to wait for that to occur. And if they've been manipulating this stuff, you could see it rapidly unwind, which Michael Oliver will say is chaos theory, where once it starts to move, people pile on. And if they're manipulating it, they're going to really pile on because they're going to be screwed because they've been holding it down. And it's all this pressure that's about to erupt. It may work very well for the junior exploration companies. It may well work very well for them. It might. But why take a situation where you've got huge upside and you could express yourself with the least amount of risk? Why would you pile on the risk? I mean, you can do that to some extent, but that wouldn't be my only way I would play it. So maybe I'm just more conservative than others. But if I were to express my view on this, I wouldn't go 100% into the explorers. I would overweight the least risky move, and then I would underweight the more risky stuff. And that's just how I've preferred to play the markets. So I don't know. I don't like how people you get a good setup and then they just want to like pile on risk like no tomorrow and not take any of the least risk stuff. There could be an opportunity where some of these metals get really scarce, the physical metal. And then you get this gigantic divergence between the physical metal and the futures pricing. And how do you know that the mining companies aren't going to be priced off of the future pricing versus the divergence that could occur in the physical pricing? And that's your premium markup. I mean, there could be a situation, and I'm just making this up, guys. I'm not saying this is going to happen, but what if there's a situation where the physical price goes to $200, $300, $400 in terms of investment, physical price, and the futures pricing doesn't follow, and the equities follow the futures pricing for a good while. There could be divergences like that could occur in the markets, and I'm not stating that's I'm not stating that's going to happen. I'm just stating that it could happen. So I'm always in the physical camp just because of the risk is so low. And there's a point where what if this all falls apart and your brokerage account goes under, or something happens with your brokerage account, like you're owning the equity, and do you really even own the equity of it? Your brokerage might own that equity, and it might be just kind of contracted out to you and your account. There's all these weird things that could potentially occur where the way that I express the trade through the physical protects me against other potential negative downfalls in brokerage accounts and bankruptcies in brokerage accounts and et cetera, et cetera. Gary Savage says, in their frantic effort to prevent gold from closing back above 2,000, the cartel took their eye off the miners. Holes are springing up everywhere in the dam. The cartel is running out of fingers. Last day to sign up for his premium newsletter. And he's basically talking about this could potentially be held down and manipulated for gold, and obviously silver and platinum as well. They are the most shorted metals of anything. They're the most shorted market of any market. Those sectors are platinum, silver, and gold. When they lose control of this thing, we could see a big repricing, and that's going to also reprice a lot of commodities as well. And that's why they're holding it or trying to hold it down if there is manipulation going on, which I do find it a little bit weird on gold that you're getting all these weird candlesticks for the past couple of weeks. It's just weird the way that it's trading. And I know some people say, well, that's a reason not to buy it. I'd say the very opposite. That'd be the reason to accumulate physical, because they don't want this stuff to go up. They don't want people in physical. And that's exactly where I would go. I'd go where they don't want you to go. Here's platinum. This is an inverted shoulder, head, shoulder, and we just broke out of the right shoulder's trend line. Looks beautiful. We've got, this is kind of confusing here. Japan approves $110 billion stimulus package to fight inflation. He's going to create inflation by handing out money to fight inflation? That makes no sense. He says wage increases are not keeping pace with price rises. We hope to stimulate consumption by increasing people's disposable income and creating a virtuous cycle in the economy. He's going to create inflation to to fight inflation. I don't understand this. That's pretty crazy. But you know what? Let's throw some checks out there, baby. Here's platinum on a different longer term view. There's that shoulder head shoulder that uh, Casper was looking at, but this is Dow Gold. Dow Gold equals one. There's your big consolidation: one hump, two hump, three hump. The blow off fake breakout in 2020. And then we have an inverted head and shoulders that's ready to break to the upside. All I'm going to say is that's my boy Platinum. My boy Platty. My boy Platty's ready to rip. Let it rip. Here's GDXJ, another one that's breaking a downtrend to the upside. Do you think I'm starting to get bullish gold, silver, and platinum since a lot of these charts that are coming up are breaking downtrend lines? Yeah, I'm probably getting pretty bullish on this stuff. Every generation has its bubble. Human nature doesn't change. Each time people really believe that this time is different. This is tech versus the S&P 500. Tech is at an all-time high. Now, could there be a blow-off top that some people are calling for? It's possible, but why would I play that? Why would I play that? I mean, I'd play it if this was down here, tech and bought it in like the 50s. That'd be perfect. Or maybe down here, or maybe down here. But now we are way up there, and it's like, yeah, I just don't. I'll just say Homie doesn't play that. All right, Homie doesn't play that. What movie's that from? Homie doesn't play that. Yeah, I don't play it up there. It's too expensive. Silver versus the M2 money supply starting to break, or almost ready to break to the upside here. This is starting to look real interesting on the silver front here. Gold and silver versus the M2 money supply versus other asset classes versus the US dollar. I'm starting to get pretty dang bullish on all this stuff. Caution, China's dumping US treasuries very aggressively. They still hold around 800 billion worth of bonds that could be offloaded. Buckle up. Aggressively selling US treasuries. This is also putting pressure on interest rates to go up. Who's going to buy all this stuff? And what they need to do, I guess, or what they're trying to do potentially is create perhaps a recession or a slowdown in the market where it creates demand for bonds. Maybe. I don't know if that's what their goal is. I think that's what their goal is, to try to get a slowdown in the market, create demand for bonds, and slow the inflation rate down all at the same time. But these guys are offloading. Grady said before and called the gold low 1 month ago. Are you watching this major low? So we have a false breakout on GDXJ, and we're starting to rip to the upside of that downtrend line. Again, this is another inverted shoulder head shoulder as well that's ready to that's been breaking to the upside. So I've got a bunch of gold and silver mining companies, and again, I'm not too. I like the physical metals more than that, but there are opportunities in some of these mining companies to start looking. U.S. yield curve bull steepens following disappointing U.S. jobs data, with U.S. 2s and 10s yield spread ticked up 2 bips. So we're down to minus 31.6 as we're coming back up. Generally, when you approach zero and get above that zero mark, that is where a potential slowdown in the markets generally occurs. It doesn't mean that it occurs every single time. But generally, when this uninverts, that is where your problem occurs. It's somewhere in this area coming back up. You can see 2020, we were coming back up, and in this area here is where we had a problem in 2020, where we broke the one, we came just below it, came back above it, and we had a problem in 2020. Now we're coming back up, and we could have a problem as it heads above zero if it were to go above zero. Apple, this guy puts the Wyckoff distribution schematic on top of Apple, says it looks pretty similar to it. I think it does. And maybe we have a downward move in some of these tech companies. Maybe that slowdown is coming, where the yield curve comes back up above. We start getting selling pressure in NVIDIA, in Apple, and a lot of these companies that look like they're trying to put in more of a top. Or another thing is maybe this stays inverted we continue to raise interest rates as he fights inflation, and the interest rates roll over those markets. And I don't know which one is necessarily going to be the case. If it's going to be a slowdown in the market that brings this lower, or if it's interest rates that continue to march higher that brings us lower. I don't know which one it is. So we'll have to keep watching. Uranium versus, so this is the uranium spot. That's the spot. The uranium spot price there, which is the physical metal split, versus the SPX. And you can see that we've just recently broken the neckline of a potential shoulder, head, shoulder that's developed, and we could have a big run out of this bad boy in the ratio. So it's an upsloping 6-year inverse head and shoulder breakout. And someone asked me, or someone asked, on Twitter, is now a good time to sell uranium or whatever? And I'm looking at it like, guy, like, do you understand this chart pattern is like ultra bullish here? Do you understand that the price is just getting started? Like, why would you sell right at the acceleration point? I don't understand. This is set for weeks. Looks like the U.S. bonds have bottomed and yields topped. Here's further chart evidence of this. And he's using this line here. One's for prices, breakout on bond prices, and a breakdown on yields, and they're inversely correlated. So perhaps we have yields relax and bond prices go back up, which would mean that this curve could uninvert to the upside, which means there is demand for bonds, which means that maybe we do see a slowdown based in the market. Peter Schiff says the October jobs report confirms a weak labor market. The unemployment rate rose to 3.9%. Labor force participation fell to 63%. Only 99,000 low-paying part-time private sector jobs were added, mostly second and third jobs. 35,000 high-paying manufacturing jobs were lost, and government hired 51,000. We've got gold here. Gold has a huge breakout versus the U.S. Consumer Price Index from a bullish pattern. And it now has the beauty of a backtest. See the orange text. Very bullish chart for precious metals, as odds are now high it will climb the right side of the green rounded arc. And this is a breakout from the 2.5-year bullish expanding falling wedge, plus a perfect backtest with bullish engulfing reversal. The bullish engulfing is this big green candlestick there. This is your flag pattern that's slightly expanding. And we've broken that to the upside, done a retest, and now we're ready to potentially rip against the consumer price index. That would also signal a potential slowdown in the market, because the consumer price index may not go up very much or go sideways or slightly lower, and gold rips it. And that would indicate the market condition of a slowdown. That could potentially indicate that market condition. Game of Trade says bank credit has just begun contracting. This has only happened during the financial crisis. And that's that slowdown in real estate sales that we were talking about in the beginning. Interest rates ran on up. Bank credit is contracting. They're not loaning, or the demand for loans is falling, and the affordability is pretty bad. So it's all interconnected, and this all makes sense. Now, are interest rates coming back down? Is that going to spur more lending? That's what we're going to have to wait and see. So this falling down in yields and bonds going up, that could spur more bank lending, and that could also spur home builders and loans and all that stuff to move in a positive fashion. And that's what I've got for today, guys. So that's all I've got. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys would like. Use the word discount and coupon code. And we'll catch you guys later. This is Finding Value.